Hello everyone, welcome to this course of Matrix and Analytics of Marketing. Today is the third lecture of week 7 where we are discussing about various metrics associated with product and portfolio management. So this matrix helps us understanding various product strategy, various launch strategy. So in today's session we will try to dive more into two metrics. One is called the cannibalization rate and another one is the fair share draw. As far as dictionary meaning is concerned, cannibalization is all about eating up your own race. We have a similar kind of meaning in this marketing context also, like cannibalization basically refers to, let's say, every product grows through its life cycle. I mean, there are various stages of product life cycle. The first one is the introduction phase, second one is the growth phase, maturity stage, and ultimately the decline stage. So what happens, the companies needs to keep themselves updated as per the evolvement of the industry. They need to keep changing the product, they need to keep introducing new products which are more relevant, and probably the older version of various products will get obsolete gradually over a period of time. When a new product is being introduced in the market, it will eat up some of the market share from the existing set of product portfolio of the same company, and this is what is called a cannibalization. So you are basically snatching the market share for the new product from your existing set of product portfolio, right? Then another matrix is fair share draw. So fair share draw is similar to cannibalization, but it works under certain set of assumptions which we are going to discuss in the subsequent slides. Let us have a look at this definition of cannibalization rate. What is cannibalization? It is basically a market phenomenon in which the sales of one product are achieved at the expense of some of a firm's other products. It is important, though definition as it looks like it is a negative phenomenon, but it is in reality it is a positive phenomenon. It makes the company relevant in the market, it makes that the company does the technological advancement as demanded by the industry. One example that I can say is that let's say when iPhone 16 was introduced, so there is a point of time when people stop purchasing iPhone 15. Remember that this cannibalization is a gradual process. All the products of one category will not be obsolete in a single day. So gradually it becomes obsolete in the market, gradually it becomes irrelevant in the market, right. The cannibalization rate is the percentage of sales of a new product that comes from a specific set of existing products. So this is more of a mathematical how we should calculate the cannibalization rate. For example, we have introduced a new product in the market and we could sell 100 units of the new product in a defined period of time, and on the other hand we had similar kind of a product which we used to sell another 100, right, in the previous years, but this year this 100 got reduced by, let's say, 80. So what we can say is that 20 of this new demand for the new product is being snatched from other product of the company. So out of total 100, 20 are being snatched from the other product of our company. So that is why the cannibalization rate will be 20%. Cannibalization is not always negative. If the total market share increases or if the new product is more profitable, it might still be beneficial overall. Though apparently it looks like a negative phenomenon, most of the time it is more of a positive phenomenon. Let's say you are introducing a new product at the cost of some existing product, but the contribution margin that you can derive from the new product is much higher than the contribution margin that you could derive from the existing product, and overall demand remains the same. In that case, cannibalization is a positive phenomenon for the organization because it is giving you incremental gain in terms of financials of the company. The cannibalization rate measures the proportion of new product sales that have replaced the sales of existing products from the same company. So, it does not talk about stealing the market share from some other companies, rather it confines its boundary within the same company. Okay. So, this is the basic overview of the cannibalization as a metric. Now, let us move into the construction of this metric. When a company launches a new product, let us say a new flavor or a new variant or a lower price version, it may gain sales, right. So, however, the phenomenon is that some of these new sales may come not from new customers, but from existing customers who switch from the company's older products. Some of the sales may be from the new customers because probably you are expanding the overall market, but some of the sales will be generated from your existing set of customers who had been consuming some of your existing products. This internal competition between the firm's own product is known as cannibalization technically. So, this is the technical perception of what is called cannibalization. So, it actually provokes the internal competition between firms' newly introduced products and already existing products. The cannibalization rate is generally calculated as the percentage of a new product sales that represents a loss of sales attributable to the introduction of the new entrant of a specific existing product or set of products. So, formula wise it is the sales lost from the existing products, it can be in terms of numbers, it can be in terms of units and also in terms of money divided by the sales of the new product. So, this is how we can construct this metric called cannibalization rate. Now, let us have a look at this purpose of this metric. It helps us, this cannibalization rate helps us take informed decisions. As we know that whatever you are selling today, if you keep selling the same product in the market for next 5 years, probably you as a company will become obsolete. Therefore, to make yourself in the market relevant, you need to keep updating in terms of your product portfolio, you need to keep updating yourself in terms of technological advancement, right. So, this is a gradual process. So, whenever you are introducing a new product which is let us say a better version of your existing set of products, in that case you need to calculate all these things. You need to calculate what could be the possible cannibalization rate and what will be its impact on the finances of the company. So, if you are already calculating all these things, probably you will not be encountering a shock at a later point of time. Any company considering the introduction of a new product should confront the potential for cannibalization. There will be cannibalization if especially this product is solving the similar kind of problem, but in a better way. So, this is going to cannibalize some of your existing set of products. A firm would do well to ensure that the amount of cannibalization is estimated beforehand to provide an idea of how the product line's contribution as a whole is going to change. Anticipation, confrontation, estimation beforehand is very important. If this cannibalization rates, calculations and estimations are performed properly, this analysis will tell a company whether overall profits can be expected to increase or decrease with the introduction of the new product line. It will make yourself ready for the upcoming business dynamics, right. So, now quickly let us have a look at one of the example. A company has a single product that sold 10 units in previous period. The company plans to introduce a new product that will sell 5 units with a cannibalization rate of 40%. So, what does it mean? Cannibalization rate is for this one 40%. That means 40% of the new product sale will come at the expense of the existing products. So, you can just look at what is the 40% of this total demand for the new product, it is 2, 40% multiplied by 5, that is 2 units. So, 2 units should come at the expense of the old product. So, earlier how many units of the old products were being sold? It was 10 units. Now 10 units minus 2 units. So I will be able to sell only 8 units of the old product, and additionally I am selling 5 units of the new product. So in a way my total number of units sold in terms of old products and new products will be 8 plus 5, that is 13. Remember that in this entire scenario what I am doing basically, so basically for this 8 old products we have existing set of customers. For the new 2 products who have switched from the old product, they are also our existing set of customers. Now this additional 3 we have generated the new set of customers. In this process of cannibalization we are actually expanding our market as well. So whether this particular proposition is beneficial for the company or not will be determined by what is the contribution margin of the new product and what was the contribution margin of the old product, and what is the overall investment required in order to launch the new product. All these things will determine whether it is a beneficial proposition or not. Now look at this one, another example of cannibalization rate. Lois sells umbrellas on a small beach where she is the only provider. Her financials for the last month were as follows. Umbrella sales price per umbrella was $20, and we know we have already discussed what is called fixed cost, what is called variable cost. Let us say the variable cost per umbrella was $10. So what will be my contribution margin? My price minus variable cost gives me the contribution margin. So umbrella contribution per unit is $10, 20 minus $10, it is $10. So number of total units sold is, let us say 100 units. So what am I gaining out of this business is 100 multiplied by 10, that is $1000 per month. Let's add something to this scenario. Next month Lois plans to introduce a bigger, lighter weighted umbrella. Let's say let us call it a big block. So as far as big block is concerned, the projected financial for the big block are, let's say, as follows. The selling price for per unit of big block is $30, and the variable cost associated with per unit of big block is $15. Now what will be my contribution margin for big block? It is $15, 30 minus 15, that is $15. Now the total unit sales per month, let us say it is 50 units. So how much I am deriving from this new product? It is 15 multiplied by 50, that is $750, right. But remember that as I am introducing a new kind of or upgraded kind of a product, it is still an umbrella. So it is definitely going to cannibalize some of my existing products. Let us say in our previous example the total unit sales per month was 100. So definitely it will get reduced by some extent. Fine. So this is what is the phenomenon of cannibalization. I can assume that if there is no cannibalization, Lois does expect her total monthly contribution will be 1000 from the old umbrella and 750 from the new umbrella, that is the big block. So overall it will be 750. But in reality what is going to happen, that the unit cannibalization rate for the big block will be 60%. Means whatever demand is derived from for this particular product big block, 60% of it is coming from the existing umbrella, normal umbrella. So as per these assumptions, her projected financial after accounting for cannibalization can be like this. So big blocks unit sales is 50, right. So cannibalization rate is 60%. So how many is coming from the older product? It is 50 into 60%, that is 30. So how many units of the older product was sold before introduction of this product? It was 100. Now 30 less units will be sold for the older product. So 100 minus 30, that is 70. Instead of 100, the older umbrella will be sold, the quantity of older umbrella sold will be 70. Now the total new total contribution for the regular product, for the older product will be, that is 70 multiplied by 10 contribution per unit, that is 700. And for the new big block umbrella, what is the this one overall contribution, it is $15 multiplied by 50 units, so it is 750. So her total contribution will be 700 from the older product and 750 from the new product, that is 1450. So earlier she had a total gain of $1000, but now she has a total effective this one gain of 1450. So she is in a gaining end. So she is, by introducing this new product, she is gaining in terms of monetary value, right. So what does it, can you reflect upon this particular scenario? In this case, though cannibalization happened, what actually happened? 30 of the older products have been replaced by newer products, but there is still no loss. In fact, financial gain was there, because a low margin product was being replaced by a high margin product, not in terms of percentage, but in terms of contribution margin per unit. Earlier the contribution margin per unit was $10, now for the new product the contribution margin per unit is $15. So if it is replaced by the new product, the overall contribution margin per unit is improving, and that is why she is gaining more profit as compared to her business in the previous month. So this is all about the metric called cannibalization rate. So what we have understood from this particular metric, this is an important metric and it is inevitable. Cannibalization will happen. We should not consider it as a negative metric. Only thing that we need to know is that we need to anticipate. Whenever we are introducing a new product in the market, we need to understand that some of our existing set of products which are solving the similar kind of problems will be cannibalized. That is perfectly okay. We need to work on the finances. We need to predict the cannibalization rate. We need to understand the difference between the old contribution margin and the new contribution margin. Then we can make ourselves, keep ourselves relevant in the market for a longer period of time. In absence of this matrix, what is going to happen? Probably we will be clueless about the future finances of our company. Fine. So now we will delve into another metric which is called fair share draw. So this is similar to cannibalization, but the thing is that it works under certain set of assumptions. The assumption that a new product will capture the sales, whether in terms of units sold or in terms of dollar, from the existing products in direct proportion to that market share held by those existing products. Right. So basic assumption is that if a new product is introduced, then let us say existing brands are there. In that case, whatever is the cannibalization rate or whatever is the cannibalization quantum, it will be attributed equally as per the existing market share. If company A, if I am stealing some market share from company A, stealing another level of market share from company B and company C, then what is the quantum I am stealing from A, what is the quantum I am stealing from B, and what is the quantum I am stealing from C, are dependent directly proportional to what is their current level of market share, right. So once we look into one example, the concept will be clear. Fair share draw is used to estimate how much of a new product's expected sales will come at the expense of the existing products. The idea is that larger players lose more and smaller players lose less, because for larger players the current market share will be very high, but smaller players the current market share will be very less. So if we compare in terms of absolute gain, then we are stealing more units from the large companies and lesser units from the small companies. It is dependent on their current market position, right. Fair share draw is the assumption that a new product will capture sales either in units volume or revenue by proportionately drawing from the existing products based on their current market shares. It assumes no brand preference, no price sensitivity or competitive reaction. In reality, which is not going to happen, this particular set of factors such as brand preferences from the brands, price discounts and competitive landscapes, they are going to play a role. But for the sake of understanding, we will keep all these things constant. The draw is purely proportional to the existing market share. So, this is the basic overview of fair market draw, fair share draw as a metric. Why is it important? It helps you estimating the demand for a product if you are launching it in a new market. What you have to look into, like who are your competitors, what are their market status, what is the market share being acquired by your competitors, and what is your expected number of units that can be sold in the market. Then whether you will be able to steal some market share from the existing companies or not. So, these estimations can be realized by this metric called fair share draw. Let us have a look at this example. Three rivals compete in the youth fashion market in a small town. Their sales and market shares for last year appear in the following table. The firm name Threadbare, the sales was $5 lakhs, right, or $500,000. Then there is another brand called Too Cool for School. Their total sales revenue was $300,000, and let us say the third brand is Tommy Hitchhiker. So, for Tommy Hitchhiker, the total revenue was $200,000, right. So, as far as market shares are concerned, if we consider it as a closed economy, then in that case the first brand will have a market share of 50%, the second brand will have a market share of 30%, and the third brand will have a market share of 20%, and overall sales in the market was 1 million, right. Let us add something to this scenario, right, and this addition is that a new entrant is expected to enter the market in the coming year and to generate a sales of 300,000. Let us assume that 2/3 of those sales are expected to come from at the expense of the pre-established competitors and 1/3 will be generated organically. Means there will be new customers, there will be market coverage expansion which will generate 100,000 additional sales, right. So, under an assumption of the fair share draw, how much will each of the firms sell in the next year? So, definitely if there is a new entrant and let us say the market conditions remain the same, if there is a new entrant, then there will be some decrease of sales for Threadbare, there will be some decrease of sales for Too Cool for School, and there will be some decrease of sales for Tommy Hitchhiker. And under this fair share draw assumption, each of these competitor will lose equal proportionate of the market. Now, how this will go like? If the new firm takes 2/3 of its sales from the existing competitors, then this capture of sales will be total 2/3 multiplied by 300,000, that is 2 lakh. So, brand Threadbare, Too Cool for School and Tommy Hitchhiker all together they have to compromise, they will have a compromise of 200,000. Under this fair share draw, the breakdown for that 200,000 will be proportional to the shares of the current competitors. Thus, 50% of the 200,000 will come from Threadbare, 30% from Too Cool for School and 20% from Tommy Hitchhiker, right. So, what we can do is like, so what is the 50% of 200,000? It is 1 lakh, right. So, 1 lakh share will be compromised from Threadbare. Earlier their total revenue was 500,000. So, 500,000 minus 100,000, that is 400,000, right. Similarly, from the second brand, it is the 30%. So, 30% of this one 2 lakh is 60,000. So, earlier their total number of units this one revenue generation was 3 lakh. So, 3 lakh minus 60,000, that is this one 2 lakh 240,000. Similarly, from Tommy Hilfiger, their market share was 20%. So, 20% of 200,000 is 40,000. Earlier their total revenue generation was 2 lakhs. So, 2 lakhs minus 40,000, that is 1 lakh 60,000, and for the new entrant it is 300,000. Now, you can recalculate the market share for each of these brand afresh. So, what will be the overall market share in presence of the new entrant? For threadbare, it is, I mean, overall market is also enlarged from 1 million to 1.1 million, right. So, now we have to recalculate the market share. So, 4 lakhs divided by 11 lakhs multiplied by 100, it will give us a value of 36.36%. I mean 2 lakh 40,000 divided by 11 lakhs multiplied by 100, it will give us a value of 21.82%. Then 1 lakh 60,000 divided by 11 lakhs multiplied by 100 gives us a value of 14.55%, and ultimately for the new entrant they are generating a revenue of 300,000. So, 300,000 divided by 1100,000 multiplied by 100 is 27.27%, right. So, this is all about how we can look into this metric called fair share draw. So, notice that the new entrant expand the market by 100,000. So, this is a new customer, this is about the new customer. We are not, as far as this 100,000 is concerned, we are not snatching any revenue from any of the company. So, which is an amount equal to the sales of the new entrant that do not come at the expense of the existing competitors. So, under this fair share draw, the relative shares of the existing competitors remains unchanged, because the snatching has been done proportionately. So, relative market share for all these companies will remain the same. Earlier it was 50, 30 and 20, now it is 36.36, 21.82 and 14.55. So, proportionately they remains the same, right. So, relative, I mean we can calculate this relative market share. Threadbare share relative to the total of the original 3 competitor is still the same, that is the 50%. Similarly, for the second brand also it is still the, I mean relative market share of these 3 brands will still be the 30%, and for the third one it is still be the 20%, right. Now, look at this purpose of this metric fair share draw. Fair share draw is the assumption that when a new product enters a market, it will pull sales away from existing competitors in proportion to their current market shares or market strength. This particular concept is most commonly used in volume and revenue forecasting models in marketing, especially during the test market simulations or scenario planning stages, right. So, as far as the utilities of this metric is concerned, the significance comes from various aspects such as forecasting tool. It can be used as a forecasting tool. It can be used for the purpose of portfolio planning, like whether we should add some new product to the existing product line, or we should eliminate some of the products from the existing product line, or is there any need to, I mean extending the product line or contracting the product line. So, all these decisions can be taken with the help of this metric. Then this is another aspect of this metric is it is simple to understand. Assumption is quite simple. Remember that these assumptions are a bit far from the reality, but still for the sake of simplicity it helps us in forecasting. This particular metric helps us in test marketing and ultimately the market impact estimation. Whenever a new product is introduced in the market, what is going to be its impact. I mean, how much of the market share will be snatched from the existing set of products. So, basically it I mean tries to give a picture regarding the impact assessment. New product is introduced, so what will be its impact on the existing products? Is it proportionate, or I mean some of the products will be highly impacted or some of the products will be less impacted. Now, we will just try to establish the relationship between the fair share draw and cannibalization. Fair share draw can be used to estimate the cannibalization within a company's own portfolio. We are extending the concept of fair share draw in specific conditions. When the company launches a new product, the fair share draw assumption can help distribute the expected loss among its own existing set of products. Then it helps us in production planning, it helps us in our human resource, because let us say if new product is introduced, what will be its impact on the existing set of products. I mean if we have this information in place, then in that case we can plan our production accordingly, so that there is lesser inventory cost. In absence of this, probably we will produce as we used to produce earlier, and those will be wasted, there will be more inventory cost associated. If the new product draws disproportionately from the firm's own brands, the cannibalization rate is high, indicating that the company is merely shifting volume, not growing the total portfolio. So, if everything is taken from your own set of products, then I mean the company is not growing, probably it is just replacing the existing product. If most volume comes from the competitors under the fair share draw assumption, cannibalization is low and net market gain is more, right. So, you are actually your new product is becoming dominant in the market, fine. So, with this I will conclude today's lecture. I will see you in the next class with a new topic, some of the new metrics associated with marketing. Thank you.